Hello, everyone, and welcome back to Synaptic Investing. I hope you're having a fantastic week and are ready for another deep dive. We are absolutely thrilled to have you here with us as we peel back the layers of the financial markets to understand what makes them tick. Today, we're breaking down one of the most interesting situations on the market, the managed care player, Molina Healthcare. Now, I know you might be thinking, insurance, really? Isn't that a bit dry? But trust me, this isn't just a story about a boring insurance company. It's the absolute center of a massive market dislocation. We are looking at a stock that is down somewhere between, 25% and 33%, all following what can only be described as a catastrophic Q4 earnings miss. This is a crime scene, folks, and we're looking at the chalk outline on the pavement. On the surface, it looks like a fantastic value play. I mean, you see it trading at around 14.7 times earnings with a massive guaranteed government revenue stream. It almost seems too good to be true. But the real question for us as allocators, and for you as investors, is simple.
Is this a massive overreaction providing the buying opportunity of a year? Or is the business model fundamentally broken? Is this deep value, or is it a value trap that is going to grind its way down to zero? We are going to find out if there are hidden cracks in the fortress that the market is ignoring. That's what we're here to find out.
That's a huge topic. And honestly, the divergence in opinion on this name right now is it's wider than I've seen in a long time. Before we dive deep, a quick heads up for the audience.
Right. If you're looking to invest, we use Interactive Brokers. Use the link in the description for a stock bonus when you sign up.
It's the best way to get a bonus and support the channel at the same time.
And while you're there, please like, subscribe, and let us know your questions in the comments. We read everything, and it really helps us tune these deep dives to exactly what you want to hear.
Now let's get into it. Pillar number 1, the business model. But first, you're right, let's set the scene because context is everything here.
Absolutely. Let's just freeze time. The date is February 7, 2026. And we are looking at the aftermath of a total bloodbath. Molina Healthcare, ticker symbol MOH.
Right.
The stock price is hovering right around $131.72. Just to give you a sense of scale, the market cap has been compressed, really squeezed, down to about $7.6 billion.
And that's off of highs that were, well north of $10 billion?
Oh, easily. This is a significant destruction of value in a very short period of time.
And just to underscore the severity here, we are looking at a valuation that just screams distress. The EV/EBITDA ratio, which is, essentially the enterprise value divided by its cash operating earnings, is sitting at approximately 6.0x.
6 times EBITDA. That sounds incredibly low. For any company, but especially in healthcare.
It is historic lows. In the world of healthcare and insurance, where stability is usually the name of the game, right? That's what you're paying for.
You pay a premium for predictability.
Exactly. A 6x multiple is the market effectively saying, we don't believe you can grow anymore. In fact, we think you might shrink. It's pricing the company as if it's a melting ice cube.
Exactly. It's priced for disaster. But before we get into the valuation math, I want to back up. I want to make sure everyone listening understands the actual machine here.
Good idea.
Because insurance accounting can be a bit of a black box. And frankly, people get confused between commercial insurance, like what you get from your employer, and what Molina actually does.
Yeah.
So can you crack open this black box for us? What is the actual business engine of Molina Healthcare?
It's actually simpler than it looks on the surface, but the mechanics are very distinct from a standard commercial insurer like a United Health or a Cigna, for example.
Okay.
Molina is, at its core, a government contractor. That is the mental model you need to have. Just burn that into your brain. They don't typically sell insurance to you or me directly through our jobs. They work for the state and federal government.
So their customer isn't the patient. I think that's what confuses people.
No, absolutely not. The patient is the beneficiary. The customer, the one writing the check, is the government. It's a B2G model, business to government.
Okay, that's a crucial distinction. So walk us through the money flow. How does it work?
Okay, so the input into the business is what we call capitation. It's a fancy word, but it just means they receive a fixed check. It's a per member per month payment, often referred to in the industry as PMPM.
PM?
Right. This comes from state Medicaid programs for low-income populations and from the feds for Medicare for the elderly and disabled. And the key word here is fixed. That revenue is fixed. They get that check whether the member goes to the doctor 0 times or 100 times in that month.
Okay, let me stop you there because this feels like the absolute pivot point of the entire business model. In a traditional fee-for-service model, a hospital or a doctor gets paid every time they do something, right? They send a bill.
Correct. More services, more bills, more money.
Here, Molina gets paid a lump sum to manage a life for a month.
That's a great way to put it. Think of it like a gym membership versus a personal trainer. A personal trainer charges you for every hour you're there. A gym charges you a flat fee. The gym makes the most money when you pay your fee but never show up to use the expensive equipment.
Right. The business model works best on the people who don't use it.
Molina operates on a similar principle of risk. They are taking on the financial risk for that population's health.
So that's the money coming in. It's a fixed bucket of cash from the government.
Right. And the output is them paying for all the medical care of those populations. They pay the hospitals, the doctors, the pharmacies, the lab tests, you name it. Everything. And so the profit model is entirely dependent on the spread. It's the difference between that fixed check they get from the state and the actual medical bills they have to pay out.
It sounds less like insurance and more like almost like an arbitrage trade.
Yeah.
You're taking a fixed pile of cash from the government, let's say $1,000 a head per month, and you're betting, I can keep this person healthy for $850.
Yes.
And if you do, you keep the $150. But if they get really sick and it costs $1,200, you eat that loss. You don't get to go back to the government and ask for more money that month.
You eat the whole thing. That's the mental model. It is risk arbitrage on human health. And that spread, that difference between the check you get and the bills you pay, is the holy grail. In this industry, we don't really talk about gross margin the way you would at Apple or Tesla.
Right.
We talk about the inverse of it. We talk about the MCR.
The medical care ratio.
Right. And I want to pause here because if you don't understand MCR, you cannot understand why this stock is down 30%. It is the single most important number on the spreadsheet. The MCR is simply, for every dollar that comes in the door, how many cents go right back out the door to doctors, hospitals, and pharmacies?
So just to be crystal clear for everyone, if the MCR is 85%, that means 85 cents of every single dollar of revenue is gone before it even touches overhead, salaries, marketing, profit, any of it.
Gone instantly. And in a good year, a company like Molina is running at maybe an 88% MCR.
Which sounds incredibly high to someone from, say, the software industry.
It sounds terrifyingly high, but that's the business. That leaves 12 cents.
Right,
Then you pay your staff, your rent, your tech. And maybe you keep 4 or 5 cents as actual pre-tax profit. It is a razor-thin business. You're dancing on the edge of a knife, always.
Okay, so low MCR is good, high MCR is bad. It's a seesaw. The lower the MCR, the more profitable you are.
Precisely. And this brings us right to the crime scene of Q4 2025. This is where the story pivots from steady compounder to absolute crisis management.
This is the murder weapon we alluded to in the intro, so let's get specific.
Yep.
In the fourth quarter of 2025, Molina reported an MCR that didn't just miss expectations. It blew them out of the water in the worst way possible.
It really did.
The medical care ratio spiked to 94.6%.
And 94.6. I cannot stress enough how catastrophic that number is in this specific business model. It's almost a rounding error away from 100.
It's unbelievable. To give that context, what was it the year before? In the same quarter.
The previous year, it was roughly 90.2%. So we are talking about a 440 basis point swing, 4 percentage points.
Which doesn't sound like a lot in isolation.
No, but in this business, it's an earthquake. In software or retail, a 4% margin compression is bad, but it's manageable. You adjust. In managed care, where your gross margins are maybe 10% to begin with, a 440 basis point swing means your gross margins collapse from about 10% to 5%. Overnight.
That is a 50% haircut on gross profitability.
It's a 50% haircut. That is absolutely wild. It means for every dollar they took in during Q4, they spend almost 95 cents just on medical bills.
That leaves barely a nickel. A nickel to pay for their buildings, their entire staff, their technology, their compliance officers, everything else. They were essentially running the business for free, or even at a loss once you factor in operating expenses.
Exactly. It effectively wipes out the bottom line. It vaporizes it. And that creates a massive crisis of confidence for investors because the market assumes that these companies are good at one thing above all else, predicting medical costs.
It's their whole job.
That's their entire job. When you miss by that magnitude, it tells the market you have no idea what's happening inside your own patient pool. The black box is broken.
So we have a business where the costs just exploded. Now, usually when I think of a business facing rising costs, let's say a coffee shop where the price of coffee beans goes up, they just raise the price of the latte.
Right.
They pass it on. That's called pricing power. And that brings us to our second pillar, the Moat assessment. Does Molina have pricing power? Can they just raise the price of their latte?
This is the critical flaw that was exposed this quarter, and the short answer is no. Molina has zero pricing power. In fact, I would argue they have negative pricing power in this specific instance.
Hold on. Zero pricing power. That sounds like an exaggeration. They're a massive company. They manage billions of dollars of healthcare spend. Surely they can walk into the governor's office and say, hey, healthcare's getting expensive. We need a bigger check next month.
They can try, they can lobby, they can present actuary tables, but ultimately they are a price taker, not a price maker.
Price taker.
The states set the reimbursement rates. It's what economists call a monopsony, a market with only one buyer. And when there is only one buyer, the buyer dictates the terms. And what happened recently in California is a perfect, brutal example of this power dynamic.
Right, the California situation. This was mentioned in the earnings call and the reports as a retroactive premium adjustment, which sounds very clinical.
It's a very polite corporate euphemism for the state reached into our pocket and took money back that we thought was ours.
Wait, explain that. How can they take money back that was already paid? That sounds illegal.
It's not because of how these contracts are structured. Many of these state contracts have clauses, sometimes called MLR rebates or profit corridors, that limit how much profit the managed care organization can make.
So there's a cap on their upside.
A hard cap. If the state determines that they paid Molina too much in previous years because medical utilization was lower than expected, say during COVID when no one went to the doctor, the state has the right to claw that money back.
Ouch. So let me get this straight. At the exact same moment in late 2025 that their medical costs were surging, that 94.6% MCR we just talked about, the state of California was actually clawing back revenue from a prior period.
Yes. It's a perfect storm. It's a complete inversion of the business model. Usually, you'd hope revenue and costs might move somewhat together over time. Here, costs went vertical, and revenue actually got a haircut.
The engine is running in reverse.
It's inverted. Costs are rising faster than the fixed revenue, and they have no lever to pull to immediately fix it. They just have to take the hit. They can't call up the state and say, hey, we need a raise for last quarter. It's over.
That sounds incredibly fragile. It turns the business into something like a utility, but without the guaranteed profit of a utility.
That's a great way to describe it.
So if they don't have pricing power, what exactly is their moat? Why has this company been successful in the past? I always assumed the government contract was the moat.
It was part of it, but historically the moat was based on two things: regional scale economies and a cornered resource.
Okay, let's break those down. Regional scale, what does that mean?
Healthcare is local. It doesn't matter if you're big nationally. It matters if you're big in a specific zip code, a specific county. If Molina has a huge concentration of members in, say, Los Angeles County or in Houston or Miami, they have density.
Right.
That density allows them to go to a local hospital network like Cedars-Sinai or HCA and negotiate better rates because they represent a lot of patients. They can say, if you don't give us a discount, you risk losing 20% of your patient volume overnight.
So it's buying power. Collective bargaining power against the hospitals. Okay, that makes sense. And the cornered resource.
That refers to the state contracts themselves. These are multi-year contracts, usually 3 to 5 years. Once you are the incumbent, it is very, very hard to kick you out. There is a huge switching cost for the state.
Bureaucratic inertia.
Bureaucratic inertia is a powerful force. State officials don't want to go through the headache of changing vendors every year. It's risky for politicians. You don't want headlines saying you switched health plans and now thousands of seniors are confused about their doctors.
So you have scale in certain regions and you have a sticky contract. That sounds like a decent moat. Why is the market panicking now? Why are you calling it an anti-moat or a failing moat?
Because the evidence from Q4 suggests the moat is failing. We do what we call an anti-moat check. Is the moat actually protecting the castle's profits? And the answer here is no. It's narrowing rapidly.
Why?
First, Medicaid management is becoming a commodity. It's just not that special anymore. Everyone knows how to do it now. It used to be a specialized skill to manage these low-income, high-need populations. Now, it's a spreadsheet exercise. The playbook is out there.
There's no secret sauce.
Right. And secondly, the barriers to entry are just money. And look who the competitors are. You have CVS Aetna, you have United Health and its Optum division. These companies have incredibly deep pockets. If the only real barrier to entry is having enough capital to bid on a state contract, United Health can outspend Molina any day of the week and twice on Sunday.
So the moat isn't actually keeping the barbarians at the gate. The barbarians are already inside, and they have bigger balance sheets.
Exactly. And the result of this narrowing moat is precisely what we saw in Q4. If the moat was strong, they would have been protected from these utilization trends. They would have had better negotiated rates with hospitals, or better data analytics, or better terms with the state. The fact that the MCR spiked to nearly 95% proves the moat wasn't deep enough to stop the flood. The castle walls were breached.
So we have a broken business engine and a breaching of the moat. But it gets worse, doesn't it? Because this isn't just about one bad quarter. There are macro winds blowing directly in their face. This brings us to Section 3, the macro headwinds, and specifically a term that keeps popping up in all the sources, redeterminations.
Yes. If you follow this sector, you've heard this word a million times over the last year, but we need to explain what it actually does to the economics of the business. Redetermination is essentially the unwinding of the COVID-era policies.
Okay, let's break that down for everyone. During the COVID public health emergency, the government basically passed a rule that said, don't kick anyone off Medicaid, right?
Exactly. It was a continuous enrollment provision. For about 3 years, states were prohibited from removing anyone from the Medicaid rolls, even if they got a new job or a raise that would normally make them ineligible. The rolls swelled to historic highs. But once the public health emergency ended in 2023, states began the massive process of checking everyone's eligibility again. They started sending out letters saying, prove you still qualify. This is the redetermination process.
Okay, so people who got jobs or who started making too much money got kicked off the rolls. That sounds like it just reduces revenue because you have fewer members paying that PMPM. Why is that a catastrophic risk rather than just a simple revenue trim?
Well, it does reduce revenue, and that acts as forced churn. But the insidious part, the part that destroys margins, is who leaves. It's a concept called adverse selection. Think about it logically. Who is most likely to have gotten a job during the recovery and lose their Medicaid eligibility?
Probably a younger person.
Yeah.
Someone able-bodied in the workforce.
Exactly. Younger, healthier, more mobile people, the people who might not have gone to the doctor at all that year, the people who are paying their gym membership but not using the equipment, they leave the pool.
I see exactly where this is going. If the healthy people leave, who stays?
The sickest, highest cost members. The elderly, the disabled, the chronically ill, they stay on the rolls because they need the coverage, and they likely aren't joining the workforce in the same numbers. So you have a situation where the average risk profile of the remaining pool is structurally worse now than it was 2 years ago.
That is a fascinating and terrifying dynamic. It's like running a buffet where all the light eaters and the people who just grab a salad and a glass of water and leave all walk out the door.
Yes.
And you're just left with the entire offensive line of a football team who are going to eat 5 plates of steak and crab legs.
Yeah.
But you're still charging the same average price per head.
That is the perfect analogy. And because the state payments, the capitation rates, are often based on historical data, there is a lag. The state is paying you based on the member mix from last year, but you are paying the medical bills based on the much sicker mix of today. That gap is where the margin goes to die.
So the patient pool is sicker. But there's another layer to this macro picture, something more psychological and market-driven that I think is critical. We need to talk about reflexivity. This is one of my favorite mental models in finance.
It is. It's George Soros's big idea, and it applies perfectly here. In standard economics, we are taught that the stock price is just a reflection of the business's fundamentals. It's like a thermometer. It tells you the temperature, but it doesn't change the temperature of the room.
But Soros says that's completely wrong, especially in markets.
Right. Soros's concept of reflexivity says that the stock price can actually feed back and change the fundamentals. It's a two-way street. The perception of reality can change reality itself. The thermometer can actually turn up the heat in the room.
So how does that apply to Molina, with its stock sitting at $131?
Well, think about how Molina has grown historically. For years, they've been an M&A machine, mergers and acquisitions. They grow by buying smaller regional plans. To do that, they need currency. They use their stock as currency, or they issue debt.
But now the stock is absolutely crushed.
Exactly. The currency is devalued. If they want to buy a company for $100 million and their stock is down by half, they have to issue twice as many shares to pay for it. That massively dilutes the existing shareholders. It becomes prohibitively expensive to grow through acquisition.
So the M&A growth engine just stalls out.
It grinds to a halt, and it gets worse. On the debt side, credit rating agencies like Moody's and S&P look at the market cap. They look at the balance sheet weakness. Remember that $2 per share retroactive hit we mentioned from California?
Right.
If the agencies see that and the stock crash and decide to downgrade their credit rating, the cost of borrowing money goes up.
So their interest payments go up, which lowers their earnings, which makes the stock go even lower.
Correct. It's a negative feedback loop. a negative reflexive cycle. The stock crash isn't just a change on the scoreboard. It's forcing the company to fight with one hand tied behind its back. They lose flexibility. They lose talent key employees who have stock options, see their wealth evaporate, and start taking calls from recruiters at UnitedHealth. It can become a self-fulfilling prophecy of decline.
That is a terrifying prospect for a company that really relies on growth and scale. And speaking of fighting with one hand tied behind its back, let's talk about the generals leading the army. Section 4, Management and Capital Allocation. We need to look at the report card for the CEO, Joe Zabreski.
Joe Zabreski is a really interesting figure in this story. For a long time, the market viewed him as the savior. He came in as an outsider a few years ago when the company was in trouble, and he was seen as the turnaround artist who cut costs and fixed the operations. He had a lot of credibility.
We call that process power, right? Yeah. The idea that management has a superior system for running the business, for seeing around corners.
Yes, exactly. Investors loved him. They trusted his process. But that trust has been shattered. The failure to predict this medical cost trend, the fact that they were so completely blindsided by a 94.6% MCR, suggests that management lost visibility into their own data. The process power has degraded.
Or was never really there to begin with.
That's the fear. You can't claim to have superior process power if you don't know your own costs are exploding until after the quarter closes.
It does feel like the pilot was flying blind. Oops, we ran out of gas is not something you want to hear at 30,000 feet. But let's look at their actions, not just their words. You have a test you like to run on management teams called the Cannibal test.
I do. This comes from the book The Outsiders by Will Thorndike. A cannibal is a company that aggressively buys back its own stock. This creates massive value for shareholders if, and this is a very big if, you buy the stock when it is cheap. If you buy low, you retire shares for less than they're worth, and the remaining shareholders own a bigger slice of a more valuable pie. It's magic when done right.
So how did Molina do? Did they pass the Cannibal test?
They failed spectacularly. In Q3 2025, just 1 quarter before this crash, they were repurchasing shares very heavily, and they were buying them at prices significantly higher than $131. They were buying in the high $200, even into the $300.
Oof. So they took the cash on the balance sheet, which is shareholder cash, and bought stock at the top, literally right before the bottom fell out.
They destroyed shareholder value. It's the only way to describe it. They effectively set hundreds of millions of dollars on fire. Buying back your own stock right before a massive earnings miss is the cardinal sin of capital allocation.
Wow.
It tells you that not only were they blind to the operational issues bubbling under the surface, but they were also arrogant. They thought the stock was a good value at $300. They were dead wrong.
That is a tough pill to swallow. It really calls their judgment into question on every level. And digging deeper into the numbers, there's another red flag regarding the quality of earnings. We talk a lot about EBITDA and earnings per share, but cash is king. What does the cash flow statement tell us?
It's flashing bright red. If you look at operating cash flow, OCF, for FY 2024, which acts as our proxy for the trend leading into 25, it dropped to about $644 million.
And what was that compared to the prior year? Give us some context.
The prior year, it was $1.66 billion.
So cash flow was cut by more than half.
Yes. $1 billion of operating cash flow just vanished.
That is a massive drop. So even before the big MCR miss was reported, the actual cash was drying up. Why? What does that mean?
The conversion ratio, which is how much of their reported net income actually turns into real cash, is less than 50% of its typical levels. This suggests one of two things, and neither is good. Either they are paying out claims way faster than they are collecting premiums from the government, or their accruals, the money they set aside for future claims, are eating up all the cash.
It's a working capital problem.
A huge one. And just to clarify for the tech investors listening, this isn't a stock-based compensation issue, right? Usually when we see a big gap like that in tech, it's because of heavy SBC.
That's a great point. And no, it's not. This is a traditional insurer. SBC is very low. It's less than 5% of OCF. This isn't some accounting gimmick regarding employee stock. This is a pure unit economics failure. The cash engine is sputtering. The money coming in isn't matching the money going out in real time. Okay, so we've established the crime scene, the broken moat, the macro headwinds, and the management failures. It sounds incredibly bleak. It really sounds like a company I wouldn't touch with a 10-foot pole.
Right.
But, and there is always a but in investing, price pays for a lot of sins. If a stock is cheap enough, even a pile of burning tires can be a good investment.
That is the eternal truth of value investing. There are no bad assets, only bad prices.
So let's get into Section 5, Valuation. We said earlier the EV/EBITDA is around 6x. Let's do the deep dive calculation here. Is 6x cheap enough to compensate for all this hair?
Okay, so at 6x, the market is pricing Molina as a terminally challenged asset. The market is effectively betting that these higher margins will never recover. The current price of $131 implies that the historical MCR levels of 88-89% are gone forever.
So the market is pricing in a permanent state of distress. It's saying this is the new normal.
Yes. So our job as analysts is to triangulate what the fair value could be if the market is wrong. I like to use 3 methods. I want the listeners to grab a napkin and a pen. Let's walk through the math together.
Let's do it. Method A, the bull case.
Yeah.
This is the scenario where everything gets fixed and the sun comes out tomorrow.
Method A is what we call normalized earnings power. Let's assume the company stabilizes. We'll start with revenue of about $40 billion, which is in the ballpark. Now, historically, their net margins have been in the 4-5% range. But let's be conservative. We're not going to assume a full recovery. Let's just assume they can get back to a 3.5% net margin.
Okay, so a partial recovery, not a full return to glory, but they stop the bleeding and find a new, slightly lower level of profitability.
Right. If you do that math, $40 billion in revenue times a 3.5% margin gives you net income of about $1.4 billion.
Okay, $1.4 billion in profit. And how many shares are outstanding?
Roughly 57 million shares. So you divide that $1.4 billion by 57 million shares. You get earnings per share, EPS, of about $24.50.
$24.50 per share. Okay, that's a healthy number. And what kind of multiple do we put on that in this bull case?
A standard, boring, average multiple for a managed care company is around 12x earnings. So if you put a 12x multiple on $24.50, you can do the math.
That's roughly $294 per share.
$294. And the stock is trading at $131 today. That is a multi-bagger. That's more than a double. That is the pot of gold at the end of the rainbow if, and that is a big if margins normalize.
That is incredibly tempting. 120% upside potential. That's why people are drawn to buying falling knives.
Of course.
But we have to look at the dark side, method B, the distressed cash flow or the bear case. What does that look like?
This is the scenario where the patient doesn't get better. We assume margins stay compressed. We assume the new normal is this low-profit environment because the population is structurally sicker. Let's say margins stay at a miserable 1.5%.
Which is incredibly thin. That's like grocery store margins.
Razor thin. It's a terrible business at that level. At a 1.5% margin on $40 billion in revenue, you get roughly $10 in EPS. And because there is no growth and the business is incredibly risky, we have to slash the multiple. We'll use a 10x multiple.
So to 10 times $10.
You get a target value of $100 per share.
So we have a bull target of around $294 and a bear target of $100. And the stock is currently trading at $131.
Which tells you something very important. It tells us the stock is trading much closer to its distressed floor. The market is leaning heavily toward the bear case being true. The downside to our bear case of $100 is about 23%. The upside to our bull case is over 100%. The asymmetry is there on paper.
And what about method C? What are the Wall Street analysts saying? The consensus?
Well, the current average price targets from analysts are sitting around $175 to $182. But I have to give the listeners a huge warning. Do not trust these numbers right now.
Why not? These are professionals with complex models.
Because analysts' price targets are lagging indicators. They're always late. They're anchoring to the old data from before the crash. It takes time for the analysts at big banks to update their models, get compliance approval, and publish new reports.
Right.
After this Q4 miss, those targets are going to be slashed aggressively. They will chase the price down. So that $175 target is likely a mirage that will disappear in the next few weeks.
That is a crucial insight. Don't buy a stock just because a Wall Street analyst has a price target that's 40% higher than the current price. They just haven't updated their spreadsheets yet.
Exactly. Never, ever buy based on the consensus right after a shock event. The consensus is broken.
So we know the valuation range. But before we decide whether to pull the trigger, we need to do a pre-mortem. We need to ask ourselves, what kills this investment? What makes this go to zero or just stay dead money forever? Let's get into section 6, risks.
There are 2 fundamental kill risks here, things that would make me sell and never look back. The first one is regulatory capitation risk.
Which goes back to that California clawback issue we talked about.
Right. The existential risk is that the contract between the state and the insurer is fundamentally broken. If states continue to impose these retroactive adjustments, basically saying heads we win, tails you lose, then the business model is simply uninvestable.
It's a rigged game.
It's a rigged game. You cannot run a public company if the government claws back your profits every time you have a good year, but leaves you to drown when you have a bad year.
It turns into a utility with a capped upside and an unlimited downside. That is the worst business model in the world.
Exactly. That is kill risk number one. Kill risk number two is structural inflation.
Are we talking about regular CPI inflation or specifically medical inflation?
Medical inflation, specifically. The question is, was this Q4 surge just a bad flu season and a spike in RSV? Was it seasonal? Or is it structural and permanent? We have to talk about GLP-1s.
The new weight loss drugs, Ozempic, Wegovy, Mounjaro, everyone is talking about them.
Right. These drugs are medical miracles, but they are incredibly expensive. We're talking $1,000 a month per patient. If the state mandates coverage for GLP-1s for obesity, or if inpatient hospital spikes are becoming the new normal because the population is just sicker, then Molina's fixed revenue model is going to bleed cash for 12 to 18 months before the rates can be reset.
That's a long time to bleed cash. And even if the rates do reset higher in 18 months, the state might just see you're profitable again and claw it back.
Precisely. It connects back to kill risk number one. And there's one more risk, specifically related to management behavior. We touched on it earlier, what Buffett calls the institutional imperative.
This is the risk of empire building.
Yes. Management has already signaled a muted 2026. They know the core business is struggling. The great fear for shareholders is that they will try to do a desperate M&A deal, buy a competitor, buy a tech platform, buy anything to try and purchase the growth they can't get organically.
Diversification, as Peter Lynch called it.
Exactly. Buying a bad business with shareholder money just to show top-line revenue growth, that usually ends in tears for shareholders.
Okay, we have unpacked the business, the disaster, the valuation, and the risks. It's time to bring this in for a landing. Let's go to the outro and give our final investment verdict.
Let's do it.
First, let's give it a score. Quality score. High, medium, or low? Where do you land on this?
I have to downgrade it to medium-low. I really do. Historically, you could have made a case this was a high-quality compounder, but the process power failed. They didn't see the costs coming, and the moat proved porous. The state contracts didn't protect them from regulatory clawbacks or utilization spikes. You cannot call this a high-quality business right now. It is a fixer-upper.
Agreed. Medium-low quality. Now, valuation score.
Valuation is cheap. It's just cheap. It's trading at roughly 0.2x sales and 6 pi EBITDA. It is priced for disaster. There is no premium in this stock whatsoever. It is a classic cigar butt.
So we have a low-quality situation trading at a cheap price. The classic value investor's dilemma. So let's summarize the entire thesis for everyone.
The bull case relies on one thing: mean reversion. You are betting that the Q4 MCR spike was temporary. It was just the flu, seasonality, a bunch of one-offs. You believe margins will revert to that historical 88% level by 2027 because states are legally required to pay actuarially sound rates. Eventually, the state must raise the payments to match the costs.
Or they get bought.
Or they get bought. That's the other bull case. At a $7 billion market cap, a giant like Cigna or someone else could buy them for lunch money just to get the Medicaid exposure.
Okay, and the bear case summary.
The bear case is structural sickness. The patient pool is permanently worse after redeterminations. Management is incompetent and has lost control of the data. And they will destroy the remaining capital by buying back stock at the wrong time or making bad acquisitions while the ship is sinking.
So here's the challenge. We have a red team challenge for the listener. I'm going to play the devil's advocate here.
Why?
Why should I not hang up and buy this right now? The asymmetry seems compelling.
The red team argument, and it's a strong one, is that this is a value trap. You might look at your screen and say, oh, it's 14x trailing earnings. That's cheap for healthcare. But trailing earnings are a mirage. They're looking in the rearview mirror.
They're irrelevant now.
They're completely irrelevant. The run rate earnings, the earnings happening right now with this new cost structure, are negative or close to zero. You are buying a business with horrifically negative momentum in its core variable medical costs, facing a customer, the government, that is actively trying to pay you less. This isn't a dip. It's a fundamental repricing of the business model's risk premium. If earnings in 2026 drop to $5 a share, this stock isn't cheap at $131. It's wildly expensive.
That is a very compelling argument to stay away. Buying now really does feel like trying to catch a falling knife. So where is the actionable advice? What is the buy zone? Is there one?
I agree with the falling knife theory. I would not buy here at $131. The momentum is too negative. The bad news isn't all out yet. I think you wait. Let the analysts downgrade it. Let the optimists capitulate and sell their shares. Let the dust settle. I would look for an entry somewhere between $115 and $125.
So $115 to $125. That's your strike zone.
Yes. And you have to be very clear with yourself about what you are buying. This is not a compounder anymore. You are not buying this to hold for 10 years and put in your retirement account. This is a turnaround play. You buy at $120, you wait for the mean reversion over 24 months, you sell at $200. It's a trade, not a marriage.
I love that distinction. Know what game you're playing. If you think this is a high-quality compounder, you are going to get hurt. If you trade it as a distressed asset with a clear catalyst for re-rating, you might make some money. This has been an incredible deep dive into the mechanics of a market crash. We've gone from the crime scene of the 94.6% MCR all the way to the nuances of reflexivity and the cannibal behavior of management.
It really highlights how quickly a safe investment can turn dangerous if you don't watch the unit economics like a hawk.
Absolutely. And I want to leave you with one final thought. We talk about how the stock price can affect the fundamentals. But ask yourself this. In a world where the government at every level is increasingly strapped for cash, are companies that rely solely on government checks fundamentally safe investments? Or are they actually the most vulnerable assets in your portfolio?
That is the multi-trillion-dollar question for the next decade. The sovereign risk is real, and it's not priced in everywhere.
Indeed it is. Remember, in a falling market, liquidity is the only truth. We'll see you in the next deep dive.
Take care, everyone.